The following data are presented in respect of Quality Automation Limited. Profit before interest and taxes 52 lakh. The company has 12% debenture on which they are paying 12 lakh rupees of interest. So when we subtract interest from the EBIT, we get profit before tax of 40 lakh rupees. The tax rate of the company is 50%. So when we apply this 50% on 40 lakh, we get 20 lakhs. So that is the tax expense. So 40 lakh minus 20 lakh, we get remaining 20 lakh as profit after tax. The company has 8 lakh equity shares outstanding and the face value of each share is rupees 10. EPS is given as 2.5 rupees per share. This 2.5 is nothing but, see, what is the formula for calculating EPS? It is net income divided by number of outstanding shares. So in this question, net income is 20 lakh. Number of outstanding shares is 8 lakh. So when we divide this 20 lakh by 8 lakh, we get rupees 2.5 per share. So P ratio is 10 times and market price per share is given as rupees 25 per share. So this market price of 25 rupees is nothing but this P ratio into EPS. So we know the formula that P ratio is equal to market price per share, MPS divided by earnings per share, EPS of the company, right? So in this question, P ratio is directly given. It is equal to 10 times is equal to market price per share is something which we need to calculate. So MPS divided by EPS of the company is something which we already calculated as rupees 2.5. So MPS is equal to 2.5 into 10. We get rupees 25 per share. Now the company is planning to start a new project requiring a total capital outlay of rupees 40 lakh. You are informed that a debt equity ratio higher than 35% pushes the KE up to 12.5%, means reducing the PE to 8 times and raises the interest on additional amount borrowed to 14%. So what they are saying is the company is planning to finance a new project. So the company is planning to start a new project. And in order to finance that new project, the company needs additional 40 lakh rupees of capital. So the company will raise this additional 40 lakh rupees of capital either in the form of debt or equity or a mix of both, right? So that will bring a change in the debt equity ratio. So if the debt equity ratio is greater than 35% or if the debt equity ratio is higher than 35%, the cost of equity of the company will go up to 12.5%. And presently and currently, the P ratio of the company is 10 times. If debt equity ratio is increasing more than 35%, then the P ratio of the company will come down to 8 times. And currently the company is borrowing at 12% interest. If the debt equity ratio is greater than 35%, the company will be able to borrow additional funds at 14% interest. Now, the requirement of the question is find out the probable price of share if additional funds are raised as a loan. That is one. So you can either raise this additional 40 lakh rupees of capital in the form of a loan, or you can raise this additional amount of additional capital of 40 lakh rupees in the form of equity shares. So what the requirement of the question is to calculate the market price. They're asking us to calculate the probable price. So they're asking us to calculate the market price of the share if the additional funds are raised in the form of a loan. If you are raising this additional 40 lakh rupees of capital in the form of a loan, what will be the market price? Or if you are raising the additional capital of 40 lakh rupees in the form of equity shares, what will be the market price? So, and one more important information is given. Retained earnings of the company is 1.2 crores. Now listen, with the available amount of information in the question, how did we calculate the market price? In the question, EPS is given as 2.5 per share. P ratio is given as 10 times. So how did we calculate the market price per share? We calculated market price per share is equal to P ratio into EPS, right? So similarly, they are asking us to calculate the market price of the share if this additional capital of 40 lakh rupees is raised in the form of a loan. So if you're raising this additional 40 lakh rupees of capital in the form of a loan, your EPS will change, right? So calculate that new EPS under the first financial plan. If you're raising this additional capital of 40 lakh rupees in the form of a loan, it might change your P ratio or it might not change your P ratio. Why? Because we don't know if you're raising additional 40 lakh rupees capital in the form of a loan, we don't know what will be the new we don't know what will be the new debt to equity ratio. So that is something which we need to calculate. So we don't know whether the P ratio will remain at 10 times or it will reduce to 8 times, that we don't know. So calculate the new P ratio under the first financial plan. So multiply these two, then we will get the market price under the first financial plan. Similarly, calculate the new P ratio under the second financial plan and calculate the new EPS under the second financial plan. Multiply both, we will get the market price per share under the second financial plan also. So let's solve it. So listen, first let's calculate new EPS, right? I mean, first let's calculate the data that is required for calculating the new EPS. So this is it's a bit lengthy question. So first let's calculate the data that is required for calculating the new EPS. So here we need to calculate this figure, EPS, right? So for this, what is the starting point? We need EBIT. Can we take 52 lakh as EBIT? No. Why? Because the company is employing additional 40 lakh rupees of capital into the business. So obviously EBIT of the company will increase. They are employing more capital. So obviously EBIT of the company should increase. So we need to calculate that new EBIT first, right? But for calculating new EBIT, let's take this formula. Working note numbers 1, new EBIT. For calculating new EBIT, let's take this formula. We know that return on capital employed is equal to EBIT divided by capital employed. So first, what is the existing EBIT in the company? Return on capital employed is equal to existing EBIT is 52 lakh, which is this 52 lakh is the EBIT of the company before employing additional 40 lakh rupees of capital into the business. 52 lakh is the EBIT divided by what is the total capital employed before before putting additional 40 lakh rupees of capital. What is the existing capital employed? So here the company has raised capital in the form of debentures as well as in the form of equity shares. No preference share capital is there in this question. So the company has a 12% debenture on which they are paying 12 lakh rupees of interest. So what will be the value of the debt? So first, to calculate the capital employed, so let me put a star here. So capital employed is equal to debt plus equity. So first let's calculate this debt. So debt is equal to, so the company is paying 12 lakh rupees of interest, which is nothing but 12% of the value of the debt, right? The company is paying 12% interest and the 12% is this 12 lakh. So what is the total value of the debt? So here the company is paying, so let me put it like this. The company is paying 12% interest on the value of debt and the 12% is what? 12 lakh. So what is the value of the debt? So 12 lakh into 100 divided by 12, we get 10 million. So 10 million is the value of the debt. So value of the debt is equal to 10 million. So value of debt is 10 million plus what is the value of the equity? So the number of equity shares outstanding is 8 lakhs and the face value or the par value per share is 10. So what is the equity? It is 8 lakh into 10. So 8 lakh into 10 plus, see, equity is not only equity share capital, even retained earnings is a part of equity share capital, right? Even retained earnings is a part of equity. So we have to take the retained earnings also, which is 1.2 crores. So 1.2 crores is nothing but 120 lakhs or 1.2 million actually. So 1.2 million. So let me write it down. So the existing capital employed is 10 million plus 8 lakh into 10, we get 80 lakhs. So we can write it as 0.8 million plus 1.2 crore is nothing but 1.2 million. So when we add all these things, we get rupees, oh sorry, 1.2. . 1.2 Extremely sorry. So this is 10 million and 8 lakh into 10 is 80 lakh, which is nothing but 8 million, and 1.2 crore is nothing but 12 million, not 1.2 million. So when we add all these things, we get the existing capital employed is 30 million, right? So now just apply the number over here. Capital employed is 30 million. So 30, 1, 2, 3, and 1, 2, 3 into 100. So what is the existing return on capital employed? So return on capital employed will be, we get somewhere around 17.33 percentage. You can round it to 17.33 percentage. So this is the return on capital employed, existing return on capital employed before employing this additional capital of 40 lakh rupees. Now the company is putting additional capital of 40 lakh rupees, right? So here we have to make an assumption that assuming return on capital employed, assuming ROCE is constant. So what is the existing ROCE? 17.33 percentage before employing additional capital of 40 lakh rupees. After employing additional capital of 40 lakh rupees also, we are assuming that return on capital employed is going to be constant. So 17.33 percentage is equal to new EBIT divided by new capital employed. So 17.33 percentage is equal to new EBIT is something which we don't know. So we have to calculate it. So new EBIT divided by what is the new capital employed? So existing capital employed is 30 million. On top of that, we are introducing another 40 lakh, which is nothing but 4 million. So new capital employed will be 30 million plus 4 million. We get 34 million. 34 million. So new EBIT is nothing but 17.33 percentage of 34 million. So we will get somewhere around 58 lakhs 92,200. So this is the amount of new EBIT. So now we have the new EBIT. So we can calculate the EPS under both the financial plans. Now we need to calculate certain figures that will be used for calculating the P ratio. What is that we need to calculate? So here in the question, it is clearly mentioned that if debt to equity ratio is greater than 35%, P ratio will come down to 8 times. Currently it is 10 times. If debt to equity ratio is greater than 35%, it will come down to 8 times, right? So first let's calculate the debt to equity ratio under both the financial plans. So working note 2, debt by debt plus equity ratio. So under option 1, what will be the debt by debt plus equity ratio? So under option 1, what we are doing is we are raising this additional capital of 40 lakh rupees in the form of a loan, right? And already we have an existing debenture of 12 lakh rupees. No, we have an existing debenture of 10 million, right? Why? Because this 12 lakh is nothing but 12 percentage only. Out of the total value of debt, this 12 lakh is just 12 percentage. What is 100 percentage? 12 lakh divided by 12 percentage, we get 10 million. So we have an existing debt of 10 million. On top of that, we are raising this additional capital of 40 lakh rupees also in the form of debt. So 4 million. So the total debt is 14 million. So what is the debt to equity ratio under option 1? So option 1, debt to equity ratio will be 14 million is the total value of debt divided by debt plus equity. So 14 million debt plus what is the equity amount? We already calculated here, it is 20, no? Yeah, because 8 million plus 12 million is the total equity capital. So it is 20. Or to put it very simple, the total new, the new capital employed by the company is 34 lakh. Out of that 14 million, 34 million. Out of that 34 million, 14 million is coming in the form of debt and remaining 20 million in the form of equity. So what is the debt to equity ratio under the new financial plan? And what is the debt to equity ratio under financial plan 1? So 14 million divided by 34 million we get 41.18 percentage. So this 41.18 percentage is greater than 35 percentage. So if the company is going with option one, what will happen? P ratio of the company will come down from 10 times to 8 times. And the company will be able to borrow the additional capital at 14 percentage interest and not at 12 percentage interest. Now, similarly, under option 2, what is the debt by debt equity ratio? So under option 2, what we are doing is, so under option 2, what we are doing, we are raising this additional capital of 40 lakh in the form of only equity shares. So debt is not going to change, right? So what is the existing debt of the company? Existing debt is 10 million, which is nothing but this 12 lakh divided by 12%. So we have an existing debt of 10 million. Only this is going to be there. This 4 million is going to come in the form of equity shares, not in the form of debt, right? So under financial plan 2, the amount of debt capital is only 10 million divided by debt plus equity. So what is the debt? It is same 10 million plus how many rupees is going to come in the form of equity share capital? It is the existing equity is 20 million. We know that 8 million of equity share capital and 12 million of retained earnings. In addition to that, you are going to issue 4 million of equity share capital. So the total amount that is going to come in the form of equity is 24 million. Or to put it very simple, the new capital employed is 34 million. Out of that 34 million, 10 million is coming in the form of debt, remaining 24 million in the form of equity. So here it is 10 million divided by 34 million. So we get 29.41 percentage. So the debt by debt plus equity ratio under option 2 is 29.41 percentage, which is less than 35 percentage. So what will happen? There is going to be no change in the P ratio, no change in the rate at which the company can borrow the additional finance. Actually, the company is not at all borrowing any money here, right? Now, we have all the relevant information. So let's calculate the EPS under both the plans, P ratio under both the plans. Then we can calculate the market price per share, right? So first, particulars option 1 or financial plan 1 or option 2 or financial plan 2. So let's write the EBIT under both the financial plans. We calculated the new EBIT in the first working note. The new EBIT is 58 lakh 92,000 something. Yeah, 58 lakh 92,200. So EBIT under both the plan is 58 lakh 92,000 rupees 200. 58 lakh 92,200. From EBIT, what we have to subtract? We have to subtract interest. Now, under option 1, what is the amount of interest the company is going to pay? So here, under option 1, the company has two debt. One is the existing debt of 10 million, plus in addition to that, the company borrowed another 4 million in the form of debt. So the company has two debt. So the company has to pay two interest. So first, interest on old debt. So old debt interest, we don't need to calculate it. It is directly given in the question as 12 lakh. So 12% of 10 million, we get 12 lakh. Now, what is the amount of interest the company has to pay for the new debt? New debt. So what is the amount of debt capital the company has raised? The company has raised additional 4 million rupees in the form of debt. And what is at what rate of interest the company has raised the additional 4 million? So listen here carefully. Under option 1, the debt by debt plus equity ratio is greater than 35 percentage. If it is greater than 35 percentage, at what rate the company can borrow the additional finance? Is it at 12 percentage or 14 percentage? It is at 14 percentage because it is clearly given in the question. If debt by debt plus equity ratio is greater than 35 percentage, the company can borrow additional finance at the rate of 14 percentage. So here, this 4 million rupees, let me write it over here. 4 million rupees is borrowed at 14 percentage interest. So what is the total amount of interest the company is going to pay? 14 percentage of 4 million, we get 5 lakh 62 60,000. Yeah, it is 5,60,000. Now, what is the amount of interest the company will pay under financial plan 2? The company has only the existing debt or old debt under financial plan 2. The company did not raise any new debt in financial plan 2. So, only old debt interest will be there. 12 lakh rupees. There is no new debt. So, no new debt interest also. So, what is the EBT under financial plan 1? So, we have an EBIT of 58,92,200. From that, subtract 12 lakh and 5,60,000. We get 41 lakh 32,200 as the EBT. And EBT under financial plan 2 is 58 lakh 92,200 minus 12 lakh. We get 46 lakh 92,000. So from this, subtract the tax at 50 percentage. So from where we are getting this 50 percentage, it is again given in the question. Tax is at 50 percentage, income tax at 50 percentage. So 50 percentage of 41 lakh 32,200, we get 20 lakh 66,100 rupees. This is one actually. Okay. And 50 percentage of 46 lakh 92,000, we get 23 lakh. Oh, this is 92,200. Sorry. 46 lakh 92,200. So 50 percentage of 46 lakh 92,200, we get 23 lakh 46,100. So EBIT minus tax, we get net income or EAT. So EAT of the company is 20 lakh 66,100 rupees. So basically, it will be the same tax amount itself, because out of the total EBT, 50% is paid out as tax. So remaining 50% is remaining for the equity shareholders. So here again 23 lakh 46,100 rupees. Now, this EAT should be divided by number of shares to calculate the EPS. Right? So number of shares. So what is the number of shares outstanding under financial plan 1? So here, under financial plan 1 or under option 1, the company raised additional 4 million rupees of capital in the form of debt. So there is going to be no change in the number of shares outstanding. Correct. So what is the existing number of shares outstanding? It is 8 lakh. So under financial plan 1, the number of outstanding shares will also be 8 lakh, because the company did not issue any additional equity shares under financial plan 1. So it will be same 8 lakh itself. So number of outstanding shares under financial plan 1 will be 8 lakh itself. Now, under financial plan 2, what has happened is the company has raised this additional capital of 40 lakh or 4 million rupees in the form of equity shares. So they have issued additional equity shares, right? So what is the existing number of outstanding shares? 8 lakh. In addition to that, they have issued few more equity shares. So what will be the total number of outstanding equity shares? So that we need to calculate. So now let's see how to calculate the total number of outstanding shares under the financial plan 2. So under financial plan 2, we have this 8 lakh equity shares outstanding. That is going to be the same. 8 lakh plus we need to add the additional equity shares that are issued, right? So what is the total amount of capital the company has raised in the form of equity share capital? It is totally 4 million or 40 lakhs. Right now, at what price the company has issued this new equity shares? So it is given in the question that the existing market price is 25 rupees per share. So we can make an assumption that the new equity shares are issued at the current market price. So here, if one share is issued at 25 rupees, then how many shares are issued to raise an additional capital of 4 million? So it is 4 lakh divided by 25. So let me do a simple calculation over here also. Share and value. If one share is issued at, the value of one share is 25 rupees. Then how many equity shares should be issued in order to raise an additional capital of 4 million rupees? So it is 4 million divided by 25. We get additional 1,60,000. Right. So the total number of outstanding shares will be how much? 8 lakh existing shares. In addition to that, the company issued another 1,60,000 shares. So total outstanding shares is 9,60,000. 8 lakh plus 1,60,000, we get 9,60,000 as the number of outstanding shares. So it is 9,60,000. So now when we divide net income or earnings after tax with the number of outstanding shares, we will get the EPS. So let's calculate the EPS under both the financial plans. 20,66,100 divided by 8 lakh, we get EPS of rupees 2.58 per share. So this divided by this, we get 2.58 per rupees 2.58 per share. Similarly, 23,46,100 divided by 9,60,000, we get rupees 2.4 per share. So this is the EPS under these are the EPS under both the financial plans. Now, what we need to do? We need to multiply this EPS with the P ratios under both the financial plans so that we can calculate the market price per share. So let's calculate the P ratio under both the financial plans. So under option 1, the company has raised additional capital in the form of debt or equity. The company has raised additional capital in the form of debt. So what is the debt by debt equity ratio under option 1? It is 41.18%. If the debt by debt equity ratio is greater than 35%, what will be the new P ratio? Will it remain at 10 times or will it come down to 8 times? It will come down to 8 times. Why? Because it is mentioned in the question. If debt by debt equity ratio is greater than 35%, the P ratio of the company will come down to 8 times. So we have to take the P ratio under option 1 as 8 times. Similarly, P ratio under option 2. Under option 2, the company has raised additional capital in the form of debt or equity. What is the debt by debt plus equity ratio? It is 29.41%. It is greater than 35% or less than 35%. It is less than 35%. If it is less than 35%, the P ratio will remain at 10 times or it will decrease to 8 times. It will remain at 10 times itself. So this is 10 times. So calculate the MPS. MPS is nothing but EPS into P ratio. So 2.58 into 8, 2.58 per share into 8, we get rupees 20.66 per share. This is the market price under option 1. Under option 2, 2.44 into 10, we get rupees 24.4 per share. This is the market price under option 2. So which plan or which option the company should undertake? It is better to go with option 2 because the market price per share is greater in the market price per share in option 2 is greater than the market price per share in option 1. So it is better to go with option 2, which means the company should raise this additional 4 million capital in the form of equity share capital and not by using debt.